Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Adam Sarhan on the line. He's a founder and CEO of Sarhan Capital. Adam, how you doing today?
We're doing great. How's everything on your end?
We're doing good, doing good. We're all nestled in the office here. Got about a foot of snow, so dealing with that, but no problem. But we want to get to talk to you about the markets. You've made some pretty stellar calls the few times that you've been on the show, but what a month of January here. Is it so goes January, so goes the market, or what's your take on the month?
Yeah, no, I would definitely say if we want to recap and look at the macro picture and look at all the markets, let's start with equities. January was the worst month in over a year for the stock market. In the month of October 14, which is just a few months ago, we saw the S&P fall 8% in the first 2 weeks and then rally hard. The next few weeks was up 14%. And that was, that's almost like a penny stock. And to see the S&P 500 do that, that was almost like a cautionary sign. We spoke about it live on your show in October and said, okay, and then again in November, said, so this is not, quote-unquote, good or healthy action, especially because the Fed had just ended QE3, it was just about to end QE3, and also this bull market is approaching its 6th anniversary in March. So after a big move up, when you start seeing heightened volatility, the VIX, which is a volatility measure of the fear index, doubled since the middle of December to the middle of January, and that's a huge move. So when you start seeing heightened volatility after a big move up in the market, usually that's not a good sign. Also, all bull markets end. I'm not saying the bull market's over, but it gets a lot more difficult up here. And we had a whole dissertation. We outlined all of this and more on our research note in FindLeadingStocks.com, where we basically went through the monthly review and said, here's the S&P 500. Let's look at what happened last month. We had some heightened volatility. The daily ranges for all of the major averages were a lot wider than they had been in months. So the leading stocks, they just have not been working as well as before. There have been some big breakaway gaps on earnings, which is normal, happens every earnings season. But for the most part, the big uptrend, that relentless grind higher, has stopped. And now we've been moving sideways for the past few months.
So
one of my trading rules is the next move wins. What does that mean? It either breaks down below support and a new technical sell signal is triggered, which in this case, watch 1988 in the S&P 500 and then 1971, or support is defended and it breaks out above resistance. In order for that to happen, I want to see the S&P break above 2065, which is mid-level resistance, and then 2093, which is the all-time high.
And so you're talking basis the cash, right? When you're giving those S&P.
Correct.
Yeah.
Not the futures, cash.
Right. Another thing I've been noticing too, and just if you go to the daily here, the dips under 1900. We're struggling. On Thursday and Friday, you had a lot of volatility, the 2020 level, basis the futures. Do you think that, a lot of times when the market can't get away from support, it's leaning on it pretty heavy, that chances are we're going to get another leg down here?
Yeah, that's why I'm saying the next move wins. Typically what happens, and this market's been notorious, every single time traders just say, you know what, they throw in the towel, they say the market's going to roll over, what happens? The bulls show up, the buy-the-dippers come in, and just aggressively send stocks higher to new highs. That's not normal action. The reason why that's happening is because of that bullish fundamental backdrop we've outlined on your show before, which used to be called the Fed put. It's now called the central bank put. Another massive event that happened in the month of January, which affects markets across the board, was unprecedented actions in global central banks. We saw almost every major central bank outside the Fed ease or adopt a new round of QE. The Bank of Canada did it. European Central Bank was a big one. They fired their easy money bazooka, which they doubled. They leaked to the media they're going to do 600, and then they came out with 1.2, which doubling what their asset buying process or QE was going to be. So that was very, very, a bullish surprise, if you will. The Swiss National Bank, Switzerland, these guys came out and they did a 180 in policy. They said, you know what, we've been pegging our currency to the euro since 2011, and all of a sudden we're going to stop doing that. And then the Swiss franc, if you want to look at the ETF, or I guess you guys have futures, it just soared. It took off. So what happens is you're seeing one by one, these currency markets or the currency wars that we've outlined before have just exploded, and they're continuing to explode. And currencies affect everybody. And the currency market is the largest market in the world. The U.S. dollar has been going straight up. The euro has been going straight down. And the yen and Aussie and even the Canadian dollar, they're getting crushed, and they have been for months. So these central banks, underneath the surface, without being headlined, they're almost like they're fighting each other to see who can stimulate their economy by devaluing their currency. That was working great up until recently. About 6 months ago, the U.S. dollar said, you know what, I'm not going down anymore. I'm going to start going up. And then what happened was the U.S. dollar, everybody started piling into that trade because the Fed, the notion was they're going to stop their easy money or start raising rates later this year before other central banks because the U.S. economy is in stronger shape. And that was a quote-unquote paradigm shift, if you will. So from capital, if you look at where capital is flowing in a way in which it's helping investors allocate to the areas that have the best return. And right now, bar none, it's the U.S. dollar as a massive, and U.S. bonds as a massive quote-unquote safety trade. I also like gold because gold's starting to break out a little bit here. It stopped going down. It had the chance to implode like other commodities. It didn't. And a lot of money is moving into gold and silver, and gold and silver stocks also were featured heavily in our weekend report over on FindLeadingStocks.com. Was a big area of accumulation or just capital from institutions is flowing into that area. So that's another area to watch if you're looking for the people, the bottom dippers, or the buy the dips crowd, or even the bottom fishers, if you will. There, a lot of capital is moving into gold and silver stocks, and even gold and silver itself.
We got a quick question coming out of the chat here, and they want to get your opinion. Do you think that the 5-year bull market might be skewed due to that nearly 20% correction we had in 2011? That's about as close as we got to like a bear market status. What's your take on that?
Yeah, I think it's more semantics than anything else. You could label it and say, yeah, you know what, it's a 4-year bull market now instead. No, it's a mini bear market. And a lot of people go back and forth and argue that. I just care about what's happening now. How do I make money right now? That's all that matters to me. So if you want to label it bull, you want to label it bear, all that fun stuff. All I know is that we've had a huge move since the '09 low. You have not had a 10% correction or more since 2012. The closest we got was 9.86% in the S&P back in October, but it didn't actually hit 10% from a prior high. So the fact that we haven't even had a 10% correction since 2012 in and of itself is extremely bullish.
And
right now we're transitioning. We're almost like we're in a toppy phase. The prior toppy phase was in the summer. It broke down, but quickly jumped right back up. So right now, if support breaks, that's what I'm saying the next move wins.
Okay. You mentioned gold stocks here, and you are getting a pullback off the $1,300 level. You said you were talking about it on FindingLeadingStocks.com, your other site. What are some of the gold stocks that you're looking at, maybe that investors may want?
Let's look at GLD, which is the ETF that tracks gold. Let's look at SLV, which is the ETF that tracks silver. And now let's just talk from a broader macro sense.
Okay.
What's happened in those two markets? Back in 2013, I was short gold, and it had that huge move, that down 200 points in 2 days, if you guys remember. And gold and silver have both been in a bear market since 2011. So they're by bear market, I mean a 20% correction or more, more than a 20% decline. So it's important to note that both gold and silver are in bear markets right now using that strict definition. Now, in 2013, we were short. In 12 and 13, we had made a lot of money on the downside. And then in June of 13, the last day of that quarter, I remember it vividly because I was in the position, all the way up until the end of 14, gold and silver just built a huge base. Gold specifically, 1180 was that number to watch, 1179. And then all of a sudden, it broke below there in November when we spoke about it. And then it quickly, almost a few days later, jumped right back above it. So it negated the breakdown, if you will. So what that means is that a lot of institutional money, big buyers, are stepping in and defending, and then gold started trading back in the middle of that base, where 1180 was support. You saw a lot of big buy tails come in, meaning a lot of big up moves on heavy volume. And now all of a sudden, in the month of January, when everything is getting hammered, crude oil and other commodities, the ags and softs, gold and silver are actually up, and they're up nicely, and also on volume. So a lot of short covering and also a lot of new buying coming in. Having said that, let's look at the miners. The GDX and the GDXJ, they track the gold miners and the juniors. So the GDXJ is the juniors, GDX is just the minors. Look at that on a daily chart or on a weekly chart, and you can see the same exact scenario. You kind of broke down a little bit in November, then it jumped right back up, and the last 2 months, it's been going straight up. So there's a lot of money, and every time it sells off, you big up days, positively reversed, outside reversal days, all the bullish terms you want from the candlestick world, just big bars, for lack of a better way of explaining it, of heavy buying coming in near these lows. So it tells me as long as, last year's lows in that 1130, 1150 area hold in gold, we're probably going higher.
Okay. All right. That's a great assessment. I mean, you got the support, right? And I think you talk about in a lot of your trades is, you're using the levels. If you're in and you get, if you're buying the GLD or the GDX here at the $22 level, hey, it gets under 18, you get those lows, you have an out. I mean, sometimes getting stopped out of a trade, is a relief. Hey, you had to set up, it didn't work, and now you move on. But you made some great points in the gold market. Well, Adam, we've talked to you a lot about crude oil, and man, it is just tearing people apart here. $4 range. I got caught. I mean, now the spoos are traded tick for tick with the crude. I mean, I can't compete in that game. What's your advice?
Yeah, let me step in there also, guys. I mean, here's the deal with crude oil. It's a global commodity, right? We spoke about on your show. We said we were short, and advisor shorts right near the $90 area, 91, 89, right in that range, and it just imploded. If you look on a monthly chart, let's just step back. Just like every other market in the world, we believe markets trend. That's the core of our thesis. And you've seen now for the last 7 months in a row, consecutively, crude oil has been getting hammered every single month. So you've had and it's also in a bear market, you've had a massive decline. After that big move, just last week, it built maybe a 3 weeks tight shelf or a 3 weeks tight little base here. It tried breaking down, and immediately, overnight, it was defended, and then it soared Thursday and Friday. Friday's 7% rally was just insane. So what's happening now, the biggest moves in the stock market or any of these markets that we put oil, commodities, Forex, whatever you look at, the biggest moves from a volatility standpoint occurred during bear markets. So if you remember back in 08 or 09, the S&P 500 Dow had like days where it was up 800 or down 700 or 900 or whatever craziness was going on. Those massive moves, or in crude oil, 7.5% rally on Friday. That's just, the last trading day. They're not quote-unquote normal moves. The reason why they happen is because you have a confluence of two very important overlapping forces. You have a lot of short covering coming in, so a lot of shorts that had made a lot of money or want to lock in that gain for end of month, or they want to lock in that gain for whatever reason because they're fearful that they're going to lose those profits, and they know it's extended on the downside, and that those mean reversion guys come in. And then you have a lot of the new buyers that buy the dips come in. And so, you know what, this is a cheap asset or undervalued asset, whatever the case is, where they ignore the technicals, but they're more fundamentally driven, and they're like, I want to be accumulating XYZ at these levels. So the confluence of those two factors, the short covering and also the new buyers at those lower prices, leads to massive moves, exaggerated moves in both directions, up and down. Because those buyers that get in, if it's rejected and the price falls again, they're going to be selling. And that leads to more selling. And then, selling begets selling, if you will, and strength begets, buying begets buying. So that's the underlying psychological component of why you see these massive, exaggerated moves occur during bear markets more than bull markets. Very rarely in the bull market, look at the last 5.5 years, during an uptrend in the S&P, have you seen the Dow shoot up 800 points. It just doesn't happen in a single-day session. It could happen, but it's a very rare event. Now, meanwhile, in a bear market, those 700, 800-point down moves are almost, every other week you get one of those kind of guys at the depths of those bear markets. So just the underlying weather, if you will, let's look at that as an analogy since it's cold. It's snowing by you guys right now, and we just saw the snowpocalypse from last week. What's happening? If you're in a bull market, it's sunny outside. Okay, if you're in a bear market, it's storming outside. So if you don't want to get wet and you're in a bear market, if you go outside, you have to expect to get wet. You're in the middle of a hurricane or in the middle of a snowstorm, whatever it is, it's coming down. It's coming down really hard. So always understanding the underlying condition of the market. And there's only three conditions. It's either uptrend, a downtrend, or sideways. That's it. That's all any market in this planet can do. It can go up, it can go down, or it can move sideways. And those are states. Those states change. So when you there's different states with different time frames. I don't want to get too in depth here, but there's a daily chart, there's an intraday chart, there's a weekly, monthly. So those states change based on the time frame you're looking at. But once you understand the overall environment, is it sunny outside or is it raining? If it's raining, if bear, bull, whatever the case is, understand and adapt accordingly. Does that make sense?
Sure does.
Adam, I want to get your take on some of these specific oil companies that have reported already. We got Exxon in just as our show is starting at 8 a.m. this morning. What are your thoughts on that?
If you look at Exxon, for example, they were for a long time the largest company in the world. And then all of a sudden, Apple eclipsed them, and we talked about that whole back and forth thing. Now, for the last 6-7 months, Exxon stock has been moving more or less in step with oil prices, and they've both been going straight down. So Exxon has not been falling as hard as crude oil. Interestingly enough, if you do a correlation between Exxon and crude oil, I think that the correlation is somewhere in the high 70s. So it's a 70% correlation between the price of Exxon and the price of crude. So obviously with these big crude oil or these big energy companies, their profits are highly, highly correlated with the price of energy. So when you see imploding energy prices across the board, it begs the question, not just what happened last quarter, but what's going to happen next quarter and then the quarter after and down the road, further out going forward. So the real answer is nobody knows how low crude oil is going to go. But we do know crude oil is in a bear market, and a bear market tends to bring lower prices. So if crude oil, remember back in the 90s and even early 2000s, the all-time high for crude oil was $40 a barrel. Most of the time it was trading near 20. So you're in a situation now, if crude oil just goes back to where it was for most of the 80s, 90s, and early 2000s, it could crush a lot of these big energy companies. So I was actually speaking at a private event over the weekend, and one of the guys said, listen, why don't I just buy a basket of energy stocks and just get paid a dividend, and who cares what happens to the price? My answer was twofold. First of all, if your dividend's 2 or 3%, even 5%, the stock falls 50% or 30%, there goes that. That logic's gone. Second of all, things change. If you would have talked to me in 2007 and interviewed all of your audience and asked everybody, what would happen? Would it be possible in the next 18 months for the entire investment banking industry in the United States to implode and just vanish? Nobody would have believed it. In reality, at post-Lehman, that's exactly what happened. The 5 largest investment banks in the U.S., Goldman Sachs, Morgan Stanley, Merrill, Lehman, and Bear, all gone by the end of 2008, early 2009. Goldman and Morgan are the only ones that are around, and they're commercial banks. They had to change their status. Merrill got gone, the Bank of America, and Bear's gone, and Lehman's gone. So the entire investment banking industry imploded almost overnight, within a year. So I'm not saying the energy industry is going to implode, but when you invest money, you have to look at your ROI, and you have to understand risk. If you don't respect risk, you won't make it in this business. And the people that do make it and make it very, very well are the ones that do respect risk. And that's at the core of what we do. So it's almost being humble about the process, saying let the market guide us opposed to us imposing our opinions on the market. So, being able to be flexible and humble in your approach is like, listen, we don't know what's going to happen, and no one does. If anyone does, they're just lying to you. But there's a chance, it's the probability versus possibility, right? Is anything possible? Sure, it's possible. And then the question becomes, is it probable? So I'm not saying that Exxon's going out of business or any of that type of stuff, but you have to, when you invest your money, you have to really be careful because the unexpected can happen. And if you're protected and prepared for it, then you're fine. So to buy Exxon here, sure, I understand it's building a nice little base. You've got support, which Joel talked about earlier. If it breaks support, it might probably going to go lower. But as of right now, I can't argue anyone who wants to buy it with the exit. As long as you respect risk and you have a definitive exit, then I can understand the trade. If you don't have an exit, that's when you just lead yourself to unlimited losses, and that's how you implode.
Okay, we've been on the line with Adam Sarhan. He's a founder and CEO of Sarhan Capital. He joins us on Benzinga's Pre-Market Prep. Thank you, Adam. great information. I hope our traders and investors were taking notes, because solid information there. We really appreciate your input.
My pleasure, guys. Thank you.